Hey, what's up, everyone? My name is Brandon Wong, and welcome to today's Smart Syndicator Mastermind. Today, I have a special guest with me, Dustin Miles. He's the co-founder of Momentum Multifamily. Over the years, he's purchased over 240 million in multifamily real estate. We're going to be covering the less glamorous side of real estate investing, and how he and his team have overcome the recent bumps in the market that you all have seen with interest rates, deportations, all the sort that affect us as apartment owners and folks that are looking to buy apartments. So, with that, welcome, Dustin.
Hey, Brandon. Thanks for having me. Excited to be here.
Yeah, and we actually go back quite a ways. I want to say 2015 we met, or 2014
Probably,
or
yeah,
somewhere around
around
that
there.
time.
hmm
Can you give folks a little bit of background about your beginnings in multifamily from where you are today?
Yeah, yeah, absolutely. So I got into multifamily 2012. I don't know. I'm a dip your toes in the water type of guy. So invested passively. I was a KP or a key principal, which means I signed on the loan for that deal as well. So that was 2012, a very different time. That deal was 76 units. I invested passively in another deal before kind of the thought process for me was always to kind of own and operate. And anyways, bought my first deal in 2014. So it'll be 11 years next month. And it's actually not too, it's kind of in between where Brandon and I live. It's over in Haltom City. It was my first deal, 109 doors, raised a little over 1.5 million. So prices were a lot lower then. And anyways, owned that for a number of years, and then have done a total of about 3,000 doors to date. Haven't it's been basically 2 year. Haven't gone crazy, but try to be pretty measured in the approach. And then just kind of my background, real quick, is in engineering. Went to UT Austin for engineering school. Used to work for Lockheed Martin. So yeah, it's a little bit about me.
Awesome. Yeah, and we actually I partnered as a limited partner on one of your deals in shoot, where was that? HEB,
Uh huh.
the
Yep.
that Hearst in Hearst.
hmm
Great little deal, and that was my first introduction. I actually learned a ton from you just as a limited partner. Like for anybody who hasn't invested as a limited partner with a competent operator, you're missing out on a learning opportunity. Uh,
Yeah.
and so in recent years, there have been some bumps and some turbulence in the multifamily space. How has that affected your business, and what are some situations, some things that you've had to overcome during that time?
Yeah. Yeah, so I'll kind of give just kind of going back even further. So kind of 2012 to like 2000, basically up to COVID, was kind of a golden age of multifamily, so to speak. It was you had these really just really good things happening. So you had cap rates going down, and you had rents going up, and so every and you had not cheap money, but you had financing was fairly stable and all that. So but when I first started, the bar was much lower. The levels, sophistication, all that was it was kindergarten back then compared to feel like you need a master's degree now. So it's definitely, the whole industry has matured a lot since then. But yeah, to your point, Brandon, so it was very easy, frankly, between 2012 up to about COVID or so. And it was, basically you throw down, vinyl flooring, put in two-tone paint, and you got $150 more a month. It was just,
Yeah.
it was magic. So it was interesting. So that was, operating honestly was fairly easy. So around COVID, things got real pretty quickly. And then, things got really good for, a little while after that. And then, as Brandon had alluded to, it's been bumpy really for the past 2 years. So, I was a lot of me and a lot of other people were, we were taught how to acquire, but weren't really, there weren't, now there's resources and all that for asset management, but there wasn't a whole lot. They taught you how to buy, and that was pretty much it. So we kind of had to, learn on your own a little bit and all that. So it's been challenging. COVID was interesting, but I'll kind of more focus in on the last 2 years with, interest rate hikes and we can talk about tariff stuff and some of the whatever you guys want to talk about. But yeah, the past 2 years been really challenging. Rents have been flat or negative in some instances. We've had to pull back on rents. We've stopped. We've stopped. Some renovations. We cut it shorter than we had planned to, because we're like, it just doesn't. We're spending all this money and we get $25 bump or
Huh.
$50 bump, and we're like, that doesn't, the ROI is
Yeah.
terrible. And so we stopped in some instances on renovations, at least interior units, exterior paint, all that. We made sure to just kind of knock out because it really needed it, honestly. So, but yeah, happy to dive into whatever you want to talk
Has
about.
has that created friction with your lender, or did you have different type of financing in place where they don't really have a renovation
Yeah,
schedule?
yeah, so it depends on the lender. Some of them are more picky than others. Some of them are like, "Oh yeah, that makes sense, no problem." Others are like, "Well, that's what it says in the loan document, so you need to continue to." And so what we did was we did upgrade. We just did it a lot more slowly. Instead of upgrading every unit, we did it, sometimes every other unit or every third or fourth unit. We really tried to slow down the pace. One thing that we are very big on in general, we want everything to be very uniform, because we've purchased properties where the upgrades are, there's like four or five different types of upgrades, and so but that makes it really challenging when you're going to lease a unit, because you're like, okay, what am I, stepping into for this unit? So we do want to make sure, regardless, we don't want to be patchy. We want things to make sense. We want everything to look the same. Our viewpoint on apartments is, we see this as a franchise, and we want everything, which sounds boring, maybe, but we want everything the same. We want, we're just trying to copy, Chick-fil-A and some of the other franchises that are out there, that, every time you go to Chick-fil-A or a lot of other franchises, you get the exact same, feel and experience and type of food. And that's what we're trying to deliver for our apartments.
Very cool. Last time we spoke, I was asking you about vertical integration. I
Hmm.
know that some companies prefer to do it earlier, sooner than later. What
Hmm.
uh, what goes into your decision-making process? Because I know you've selected not to do that, and you guys have a pretty sizable portfolio.
Yeah, I think there's, it would have to be kind of the right opportunity. We would want it to where someone else is, that's basically they're heading that up. I don't know how to build, a management company. I've never done that. There's pros and cons. I know of, look, if I was vertically integrated, I would probably be saying, "Hey, look, I'm vertically integrated. Come invest
It's a
with
marketing
us."
piece. Yeah.
Yeah, and so, there's like, regardless of what people say, there's always pros and cons to basically everything in life. There's no 100% that's the way, or 100% that's the way. I think there's, what people don't talk about is people that have vertically integrated and then their lender forces them to go use third party because they're
They're
not
not
doing
good
a good
enough.
job.
They're suck at it.
Or
Yeah.
they're out over their skis. So there's some people that do a really really good job third party, and or some people that are do very very good job. They're vertically integrated, yeah, I'm sure, and that's great. But yeah, it's a lot of work. It's like the offensive line of football. It's very thankless. No one, well, I think quarterbacks do, but a lot of times they don't say, "Hey, thanks for not letting me get, knocked over by the defensive end." So I think that it's a tough job. It's a lot of work,
Mhm.
and we've seen people who vertically integrate and then they went back to third party.
Yeah.
And so if we're gonna do something, we would want to do it well, and we would need help. Honestly,
Yeah.
to be able to do that. So
Yeah. It almost sounds like acquiring a pre-existing uh, management company would make more sense than trying to build something from scratch,
yep.
that comes with clientele.
Or if a regional or someone that has experience building a property management company, if they're like, hey, come and they came and talked to us, like, we would certainly listen, but it's not on our immediate road plans. There no management company is perfect by any means. We could be with any, but I think we feel like we have the best of both worlds. So, we work with Asset Living. They're the second largest management company in the country. Huge, lots of resources, get, very good pricing on things, but we have a dedicated regional and we have a dedicated accountant. So it's almost like we have our own management company within the larger organization. And when we need, maintenance, leasing, managers, they can pulse because they have in Houston alone 30,000 doors. So they can pulse the rest of those other complexes to see who's interested in, to work at one of our communities.
Yeah, they've got a deep bench. That's
Hmm.
one of the things that you
Yep.
want to look at when hiring a property management company.
Yep. Yep.
Um, so let's shift gears just a little bit over to the financing side of things. So interest rates were historically low for a very long time when we all understand they started to increase and then they started to increase very dramatically. Um, I know the last time we spoke, that affects everybody who bought with floating rates
Hmm.
in the past couple of years. How have you navigated that? Can you speak to HFC? Like,
Yeah.
what is HFC? How much does it cost? How long does it take? How successful is it?
Yep. Yeah. So I'll kind of back up a little bit just to set the playing field or set the perspective. So if this, probably something a lot of people, don't want to say or whatever, but if you bought in 21 or 22, um, you know, cap rates were low, and if you bought then you probably bought with a bridge loan because otherwise you probably wouldn't have won the deal. And if you bought during that time period, your bridge loan is coming due or you've extended some, and the likelihood that you've been able to create enough value to be able to refi into a fixed term loan without needing pref or without a capital call, or some injection of capital, maybe the sponsor put money in. The likelihood of that happening is not. I haven't really seen a whole lot of people that have been able to do that. If you bought kind of summer of 21, through 22, that's kind of the position you were in. So which means that if you sold, you would lose equity. Sometimes it's a complete equity loss. Sometimes it's, but you would take a haircut, most likely, of some sort. And so the what has become popular in especially in Texas, I can't speak for other states. I just focus here. It's what I know, it's where I live. And so tax abatements have became, very popular, a lot of deals traded in Texas in general. Texas has been a pretty hot market. So a lot of deals traded in, DFW, Houston, Austin. Um, and so tax abatements have been a way to kind of bridge that gap. And so what the tax abatements do, so in Texas, your largest expense in pretty much every instance, unless it's just not being run well, is property taxes. So we have deals where our property taxes were $1 million. We apply for this tax abatement program, and basically our largest expense is taken off of our P&L. Obviously, if you're not having to pay property taxes, your NOI shoots up and your value shoots up pretty dramatically. And so, we were able to, refi and things like that, into fixed rate debt. So, anyways, that's kind of the landscape. If you kind of drill down a little bit more, there's different tax abatement options. Some of people, everything we did was with a local housing authority. And so we did that. We had that option. First of all, some people didn't. But that's a kind of a more conservative approach. But the traveling you guys may have seen in the news, like, oh, the loophole, blah, blah, blah. And that it usually is referring to the traveling. And so what that means, so traveling HFC. So I live in Fort Worth, and let's say there's an apartment complex down, like just right down the road. Um, Actually, there's one right here. It has a traveling HFC. So the tax abatement for that complex was not with the city of Fort Worth, not with Tarrant County, not with anyone associated locally. It was with a county that's a few hundred miles away. I'm just gonna pick on Maverick County because I know that's one of them. And so that you were able to get the tax abatement, from there, which doesn't make any sense that they're, abating taxes on a property in Texas because they have nothing, or in Fort Worth because they have nothing to do with Fort Worth. So hopefully that makes sense. But so they're trying to fix that loophole to where other counties can't do a tax abatement for properties across the state, if that makes sense.
So in essence, the regulatory risk of them turning it off or saying you can't do that anymore is primarily with traveling HFCs, not local. Is that
That's right.
kind of what I'm
Yeah.
hearing?
Yeah.
Okay.
And so right now, the legislation is in session in Texas. And so it looks like they're probably going to fix that loophole. And so the people that have traveling HFCs are going to have 2 years to get into compliance with the local housing authorities. So that's what's
Gotcha.
being said right now. It's not finalized.
Yeah, because I know some lenders were writing into the agreement, into the loan contract, like, hey, if this ever gets reversed, you owe us that tax money. You know what I mean? Like, or
Yeah.
you need to pay
Yeah.
that. You need to come up
Yeah.
with that.
As a matter of fact, a lot of lenders aren't touching. If you have a traveling HFC, they're not touching it. So,
Okay.
yep.
So the ones that you've completed successfully were local
That,
HFCs.
yes, that
Okay.
they were technically PFC. We do have one local HFC, but
Oh,
we haven't closed on that yet. So,
so so HFC is not a blanket term for it's a tax abatement. There are different flavors of tax abatement. Is that
hmm yep,
okay?
yep.
Very
Yeah.
cool.
Yeah.
Did you hire a third party intermediary to help you with this, or did you guys do it
We
yourself?
Yeah, we did. We try to really stay in our swim lane, and then we hire people that for different they're the people that we hired. They've done probably close to 75 of these now. Whenever we hired them, they'd done around 50 or so. And so, we wanted to work with the experts. For us, I mean, we're dealing with millions of dollars of other people's money. And so, at least for me, I get real conservative real fast. And so, I just, yeah, they're not free. They're, frankly, I mean, they're the what they did for us was huge. It was a huge win, kind of for our investors. And so, if we have to spend a few bucks to get it done, then
Hmm.
yeah, I think it's well worth it. But yeah, we've seen people kind of try to figure it out on their own, and they haven't completed, or it's maybe hasn't gone as well as they hoped. And so yeah, we try to just stay in our swim lane and let the experts do what they do.
So for somebody considering this route, the tax abatement route, if they're underwriting or they're doing some financial modeling, what should they be budgeting? Um, and then second question is, there's no free lunch, right? So what are the strings that become attached to your property, and how does that
Yeah.
affect the property moving forward?
Yeah, I'll just mention that right now, a lot of there's not a whole lot of, maybe there are on the traveling, but there's not a whole lot of approvals happening right now. I think a lot of people are waiting to see what the government does before they kind of act. So I don't, if you haven't already gotten it approved, I don't know if you maybe you will, but that window is probably closing. I'm sure some flavor of it will be continue to move forward, but there's it's not super clear what all that looks like moving forward. But yeah, in terms of, like I said, there's no free lunch. I like how you use that because I use that a lot. So, but there's so it's a typically what we've seen. It's a 99-year ground lease. So a lot of people ask, oh, how long is it going to last? The biggest question that we had a bunch of questions before we kind of dove into it, but one question that we had is this going to change the dynamic of our residents? And so one thing I'll say, so I think government housing in the past is has gotten a doesn't have the best reputation in the world, and so I think they kind of swung the other way. And so a lot of these local housing authorities only want, honestly, kind of pretty properties, or at least from what we've seen. And so, anyways, it doesn't, doesn't really change the dynamic. It's based on the area median incomes. So for us, they had to, and everybody's a little bit different, but so half the complex has some sort of rent restriction. And so there's kind of two buckets. There's an 80% AMI bucket and a 60% AMI bucket. The 80% AMI bucket, so AMI is area median income. All of our residents fall into that bucket already. There's no change at all. There is a little bit of rental loss, depends on the complex and the area median income, but there is a little bit of rental loss on the 60% AMI bucket. So really, the as far as what we have to do in order to get this tax abatement, so the city does take an acquisition fee. That's negotiable, but around 1-ish%. Give or take a little bit from there. The consultant, there's some fees there, and then it's just kind of attorney fees and all that from there. We did not do traveling, but the traveling fees I've heard are their fee that they take is 500,000 to 750,000. So pretty steep, pretty sizable, and I don't think that's scaled based on the deal. I think that's just kind of a flat fee that they charge. So if you have if you were doing traveling and you had a smaller deal, it may not make as much sense there. from for us since we've closed some. So then there's, there is some reporting. So they're kind of, they're a partner, and so they want to see financials and things like that. So we actually just sent them. They wanted to kind of brag on the properties, which I thought was kind of neat, and so they asked for a bunch of nice pictures. So we just sent those over recently too. So it's kind of fun.
That's cool.
Yeah.
And I spoke with a lender about tax abatement programs, and they were saying that the property has to fit into a certain box for it to make sense. Like I think the threshold they gave us was if you're paying $1 million a year in property taxes, that's a really a good place to start. They said
Yeah.
that with the fees, with the steep fees you're talking about, it doesn't pencil out as well the smaller the property gets.
Yeah, I'd say that's true. I don't know exactly, where that threshold would be. We have a deal that, the taxes are, kind of in that 300 to 400K range. And we thought it was a win for us. I don't Once you kind of get below that, I don't know if it really, starts
Hmm.
to make sense, but obviously the bigger the better.
Yeah.
Um, so yep. We had
And it could be the difference between losing money and making money, honestly.
Yeah, for sure.
Simple
Yeah,
question
we
at that
had
point.
I mean, we had one deal where it's a decent sized deal. We had the value, we had the this is per the appraisal before and after appraisal. So the value of the property went up $12 million from this tax abatement. So it was a pretty sizable win for us. So the raise
Yeah.
there was about 14 million. So
And is the property stuck now? Or when you sell, can the new buyer opt out of the abatement program?
they could opt out. They would just have to pay
The difference.
taxes, and then value goes down. But we're seeing there are some groups that are targeting deals that are in these programs. One thing, I mean, that like I mentioned earlier, there's always pros and cons to everything, and so
Mm.
one pro that I think some people don't think about. So when when you're buying a deal, and like I mentioned, your largest expense item in Texas, at least, is property taxes, and we're always a little bit, honestly, for I'm just speaking openly. I'm always a little nervous. We work with our tax consultants, and that's all they do. Blah blah blah. But at the end of the day, we don't have, we don't have, we feel good about it. And we always work with them when we're underwriting stuff, but there's always, stuff can happen. And so, one thing that's nice about the tax abatement is property taxes are basically gone. And so, not only has the NOI gone up, but a huge variable as far as operating a multifamily deal in Texas has basically been taken off the table. So in terms of just risk, we're lowering our risk, and so I mean, because that's a huge line item. If we go from we
Right.
underwrote, let's just say we were off by 10%, we underwrote a million and ended up being 1.1 million in terms of taxes. That's a that's a huge hit to the pocketbook.
Yeah, and if you're buying with fixed rate debt, you can look at what meat is left on the bone in terms of rent bumps, like where is the market going, and
Right.
then compare that to your AM, your AMI, and say, hey, like there's still meat on the bone here, like
Yeah.
we can bring this to the threshold.
Hmm.
So you've got some clarity where there usually is none,
Yep. Yep. Yep.
or less. There's usually less. I shouldn't say none,
Yep.
but that's an interesting way to look at properties is like potentially targeting those deals that already have successfully abated. Um,
Yeah. Yeah.
Now, the process. So, from my understanding, you apply for the abatement first before you go to the lender, or maybe you had the lender on hold. You have a conversation started, but they're not going to do anything until you get that approval. How long does that process take to get the? I mean, I'd imagine there's a range, right? It's not exactly 90 days or anything like that, but
Yeah.
how long
It's
did it
it
take you on average?
It's not quick. We started the process December of 23. Um, there were some bumps in the road just because so these deals are in Houston. The mayor was changing over at that time, and then they were kind of reassembling the Houston Housing Authority board and all that. And so we were supposed to meet, I think, in April, and then we didn't end up going in front of the board until August. So it was a lengthy process, and I mean, it's a lot of work. You had to go get we had to go get an appraisal. I mean, it's we're having to put money up. There's some serious work involved, and there's a lot of back and forth as well. So I mean, it's not a simple thing, and so I think if to your point, that you mentioned it earlier as far as how people should underwrite deals and all that. I mean, it would be, if you're buying a deal and you're banking on that, I wouldn't feel, comfortable with that, honestly, because it's not a layup at all. So it's fairly challenging.
So you're looking at roughly a 6 to 12 month process from start to
Hmm.
finish.
Yep. Yep. Yeah.
And there are upfront costs that you may not recoup if it doesn't get approved.
Yep, yep. And it could be shorter than that, but that's how long it took us. There were some, weird circumstances and all that. But yeah, there's some I'm not going through we're going through one approval right now, but I've heard yeah, I mean, it might be a little slow right now just because there's a little bit of people don't know where things are going to go with the Texas legislature right now. So that could kind of slow things down, throw a wrench into plans.
Interesting. Before we jump to the next topic, let me look at our questions and see in the chat what we've got. Um, uh, for your one local HFC that hasn't closed, who's it with? How long has it taken? What hiccups are happening on that specific deal, specific to
Uh,
local?
yeah, it's with Fort Bend County, and mainly they've been awesome to work with. It was we had lunch with them. It was I don't know, it was really interesting. So it most of the hiccups from that have been more on the lending side than anything else. So yeah, originally we were going to go, so some of the deals we were looking at going Friday last year, and then the treasuries ran up, and then our proceeds, went down by a lot, and then we're like, okay, what do we do? What's our next step? So, we're moving things over into HUD right now, but yeah, that deal is with Fort Bend County, and like I said, they've been great to work with. We have a call with them kind of every other week just to kind of give updates, but yeah, been really good.
So, so it's not news to people that the lender is holding things up here. Just, just
Yeah, well,
consider that piece.
yeah, and HUD's slow, so yep.
Next question, what types of deals are you targeting now? Have you changed your buy box for 2025?
Yeah, we're so in Houston, it's 90s and newer. We only buy out in the burbs. So we want, like, we have two of our deals down there by the same builder. We want everything to look and feel the same. Very similar household dynamics for each deal. So just out in the burbs. Um, we have probably some preferences in terms of some of the deals and all that, just because if we were to have a deal near some of these other deals, then we can share staff a little bit more and kind of gain more economies of scale from there. And then in DFW, it's 80s and newer, just well located. Just I've learned learned over the years not to, you know, not to compromise on the area or anything like that. It's always interesting too. There was one deal in particular that I was looking at, and I bought in 2015. So didn't have access to any of the tools we have now, or any of the just kind of data on areas and all that. I thought the area was fine. I thought it was good. It looked like a I'd say kind of a working class type of it's a bunch of, it actually looked kind of like the area I grew up in, Fort Worth. Just the homes were built in the late 70s, early 80s. The area looked fine. We got into it, and oh my, it was it was a lot more challenging than anticipated. Then the crime was more of a factor than we anticipated too. So anyways, have a lot more tools, and you learn a lot through experience. And so yeah, just very, very picky on areas. We, just like some of the people on the phone, I mean, or on this call, we could have a lot larger portfolio than we do now. We just, we're not interested in compromising on areas.
Yeah, so sound business practice. Um, with you mentioned tools a while back. My team and I invested in RealPage. Like they've got
Mhm.
real like market analytics and data. What do you like in terms of data, like pulling data to do due diligence and optimize your
Uh,
existing properties?
yeah, we do. Yeah, we have Real Page as well, and we like that a lot. We look at crime statistics. I'm drawing a blank on the name of the web. It's a free website. It's I can send it to you afterward. As soon as we get off here, I'll remember. So
Okay.
but we use that quite a bit. Nothing beats driving by. So that, I think that helps quite a bit. But like I mentioned earlier, we work with asset living, and this is one thing that where having working with a larger management company. So one in Houston, if just because we have a pretty good presence there and all that, we've probably, because we have, it's all the same areas that we're bidding on. So we've probably either underwritten the deal, looked at the deal, or we've underwritten or offered on one of its comps. So we have a lot of data just kind of by default. And then if we don't have a lot of data on it, I bet the management company that we're working with, Asset Living, probably does, just because of how big they are. And so between that, we're able to get quite a bit of data. We just started working with Verifast on
Mhm.
to help with screening and all that, and so they're also able to potentially help out a little bit too, as far as there's different metros, there's different hot spots for fraudulent applicants and things like that. So
Yeah, we got bit in the butt by not doing as good a screening on for like a short window of time, and we had
mhm.
a whole rash of like people that paid 1 month or didn't and then never made another payment after that. So it's
Yeah,
super
it's too
important to have
bad.
some type of technology in place to check. Like there's an algorithm that will look at pay stubs and tell you if they're fake or not.
Yep.
And super important not to let that slide
Yep.
because
Yep.
it
Yep.
will
Yep.
jack up your bottom line.
Yeah, absolutely.
I have a question. I just get confused if I just want to make it clear. Dustin,
Sure.
you mentioned earlier that apartment you treat it like a franchise. What do you mean by that? I know what franchise is. I know what apartment is, but can you clarify what you mean by that?
Yeah, great question. So we want everything. So our brand in Houston is the Henry. So we have 7 Henrys around Houston. And so I guess kind of starts with that. And then everything has same colors, same signs, same operating procedures. All managers, we have them fill out a WMR called Weekly Management Report. So they have to have that filled out before they meet with us every week. And so it sounds like a lot, but it's 75 questions or so. And so they can fly through that pretty quickly. But we want everything, we're big into operating procedures, big into accountability. We want everything, sounds boring, but we want everything the same. So, and when we kind of go to sell some of these, we want, potential buyers to know exactly what they're getting into. Because people, if we've bought some deals from a few groups, and you're like, you just don't know what you're going to get. You have, instead of, we have usually we try to just do one upgrade because we want everything to be seamless. And so we've bought some deals from some groups, and they have 5 different types of upgrades, and you're like, well, what am I going to get in this unit? We'll see. And so just predictability. I think it also helps, when you're raising capital and all that, that investors kind of, they know what to expect. They know what, they're, instead of like, oh, is this a '60s deal or a 2000s deal or an '80s, they know what to expect. It also helps as far as operating quite a bit. So we can easily move maintenance, leasing managers around to help other Henrys out, very easily. So I think just in general, we just want everything being run the exact same way. It's also efficient. We don't have to. It's less things we have to think about. We could just plug and play, copy and paste, and no, it sounds boring, but I mean there's a reason why there's I don't know how many Chick-fil-A's there are or how many McDonald's or whatever there are, but there's a lot of them and they've done
Do
well. And
you
so
hold it long term, like 3 years, 5 years? Because when you said franchise, it's more of fast, right? So are you holding your property longer or shorter?
we kind of tell our investors, 5 years, 5-ish years. So, we kind of just tell them in general, like, hey, we're opportunistic. So, like there's one deal that we bought in December of 23 that we may end up selling later this year. Or no, yeah, it's December 23. So we may end up holding it for 2 years. But we bought it. It's a 2019 product, and we got a really good deal on it. The seller had they had a floating rate. They bought it with a line of credit, which didn't I guess you got to be pretty big to be able to do that. So, but we bought it from them, and I think we can probably do really well. So we may end up selling that later this year, early next year.
So the situation dictates basically.
Yep.
It's not,
Yeah,
there isn't a set timeline.
we try to stay pretty nimble. We try to, we don't have office space. We try to stay pretty lean, so we don't have a whole lot of overhead. And I think one thing, back to your point, Brandon, about being vertically integrated, I think that when you're vertically integrated, you're like, well, I don't want to sell that deal because then I won't be able to pay for those people. And so it gives us a lot more flexibility. And we can, we don't have to hold on to a certain number of units and all that. We can, if it makes sense to sell, we'll sell. We just want to do what's best for investors. And then, we treat our staff well, treat our residents well, and we think it'll, translate into taking care of our investors, and everything else just kind of falls into place.
And I think the way you just explained that is a great way to explain it to pref equity that may say they may say they only want to work with vertically integrated companies, but the way you just explained it might make a little sense to them, you know? because
Yeah.
really ultimately they should be concerned with managing risk and
Right.
the returns they can generate, and that's how you're doing it. So
Yep.
that's pretty cool. Um, let's shift gears just a bit, and you had mentioned briefly tariffs.
Hmm.
And I had mentioned deportations recently at one of our properties. We had three in 1 week that skipped because a family member was deported. Are you seeing any of that, and how are you managing these risks that I was talking about, tariffs and deportations?
Yeah, on the deportation front, we are not seeing a whole lot of that. I have spoken to some people that it has affected them very significantly, though, and to where they lose 10% of their occupancy kind of overnight. So it's targeted, it's very, it's pocket dependent, all that. And so in these deals are in DFW that have been affected, and so they're kind of building occupancy back up as we speak. So there's definitely some issues there. There's a few. So in terms of supply, supply in all the tech, pretty much all across the country is going down. So DFW is going to bring on 24,000 units this year. Houston is between 12 and 14,000 this year, and Houston's only 5,000 for next year. So I kind of see tariffs, and I see some of the deportation stuff is really going to put a drag on, in addition to the interest rate environment, is really going to put a drag on, on building more apartments, which if you own apartments now, that's a really, that's a good thing. So I think, in general, hopefully the deportation thing is temporary, and because I we have friends that are here illegally and all that, but even they're concerned too. And so they, like some of them are not leaving the country because they've been advised by their immigration attorney not to leave. So anyways, hopefully that kind of goes over. On the tariff thing. So we're buying a lot of product from overseas. And so what's happening, what we've been told right now, is that a lot of the factories in China are moving across the border into another country. And so it's the same people, and they're basically, and they can set these up pretty quickly. So there's a lot of factories that are currently kind of being just moved across the border. And that's the products that we're buying overseas that are being affected by that are toilets and lighting. The other stuff is built in other countries, like I know cabinets, I think, are in Vietnam. So in Vietnam, the tariff talks were,
I
I
think
think,
they're
pretty
working a deal
brief.
out. Yeah,
Yeah,
they
yeah,
already
I think
worked out
we're
a
pretty
deal.
brief. But yeah, the stuff with China, because if you go back and look, I think Trump he's been, I saw this, it was a clip, it was on Instagram or something, of Trump, 25, 30 years ago. He was talking to Oprah about tariffs and all that. So this is a big thing for him, and he's probably, I don't know, hopefully it resolves with China, but this could be kind of an ongoing thing, with him over the next 4 years, with China. And so a lot of them, they're moving their factories right now.
So stock up on toilets and lights. But I think I'm
Yeah,
gonna open up a business just selling
there you
toilets and
go.
lights. Just
Yeah,
yeah,
yeah. So.
cool. Um, so Dustin's a wealth of knowledge. Are there other questions in here about asset management in general, KPIs, what types of things he looks at? Like what questions do you guys have? This is a great opportunity for you to bring these up without paying 30K to a mentor to 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 get your questions answered. So, question for you. You live in Fort Worth, right?
Uh-huh. Yep.
Um, do you, is there a reason you like to focus more on the Houston market? Because I know that there's a bit of volatility in terms of insurance rates with hurricanes and the sort. Um,
Yeah.
what's the impetus behind that?
Yeah. Part of it is we honestly got a little bit of traction, down there. And so we actually had um in 2020, like right before COVID kind of happened in March and all that, we actually had an older deal in Euless. We had an offer accepted, and it was for, I think it was, this sounds high right now, but it was for 120 a door, and or it was, maybe it was 110, I don't know, it was over 100, and it was, a C class deal over in Euless. And so anyways, with COVID, we're like, hey guys, we gotta, let's pause this thing. And then they went and refied, which is fine, and we couldn't have touched their number that they wanted after that. But anyways, so when COVID happened, we were, kind of looking around. We had a lot of time on our hands, I think, similar to a lot of people. And so we're doing a lot of research. I think we're doing like up to 3 webinars a week. Like, we were bored. And anyways, but we were looking at cap rate. CBRE has a cap rate survey, and I don't know if you like numbers and stuff. It's kind of interesting to look at. But anyways, we were looking at it, and we're like, wow, whether you bought A, B, or C, it was kind of the same cap rate. And so, anyways, we had this deal that fell out of, we just didn't go under contract or anything, but it was, 110, 120 door. And so we started looking down at Houston, and we saw some of the pricing there. We're like, wait a minute, we can buy, basically not a brand new deal, but we can buy a new deal for basically the same price. And we're like, this is intriguing. So we started going down there, and we ended up buying a 2012 deal for 129 a door. And anyways, I mean, it's a nice deal, good area, and they're, developing. They've, since we purchased it, they've built two or three more complexes around there, and there's a few others. But it's a nice part of town. There's a, Chick-fil-A around the corner, Starbucks around the corner, Target, right there. That's, all of our deals are basically, there's Jason's Deli, there's Starbucks, there's Chick-fil-A, Target, Walmart. All of those are usually around where we buy.
Hmm.
And so, so we just kind of got some traction down there, and then we were trying to buy some stuff up here too, because we like the idea of owning in both markets. And right now, a little more of our focus is probably in DFW. But we were trying to buy stuff up here, and we're getting our, frankly, we're getting our butts kicked. And we were getting beat out. I mean, bad. It was, by $1 million. And so, anyways, and then we just kept on getting, more traction down there. And so we just kind of, so we had about 1,600 units down there. And we would like to do want to buy up here. And for this year, we think it's a good time to kind of enter the market up here. The 80s product is not as competitive, at least from what we've seen. It's the 90s and newer in DFW and Houston. Both you're paying, it's sub 5 cap right now. There's about 20, 25 offers per deal in both those metros for that type of product. So you're mid to high fours right now. And so the, part of what's driving that is, some of that has been from developers, because they're like, I can buy basically new product below replacement cost. Why would I go build? And so that those are, those people
Hmm.
have added to the buyer pool.
Interesting.
Mm-hmm.
Okay. Well, I don't see. Oh, there's a question here. Would you be willing to share the 75-point weekly report? Oh, we're trying to get some hookups. Uh,
Um, I'd have to see. We haven't shared that with anyone, to be honest. So it's kind of something we put together and been kind of a proprietary thing. But I can talk with Hayden. But just to set expectations, we haven't shared that with anyone, and so my would kind of be leaning towards we want to keep that internal. But yeah, if we can, then I'll definitely let you know, Brandon. So
if you don't ask the question, or if you don't ask, the question's
yeah,
always, or the
why
answer's
not?
always no.
Yeah, yeah, that's right. Yeah, for sure.
Mind if I ask a question?
Sure.
Thank you, buddy. Hey, nice to meet you, Dustin. Really quick question. When you've been doing some of your capital raising, have you been seeing and capital come in through DSTs at all?
No, and just to be very honest, like I don't know how all that works. I'd love
Yeah.
to learn more. I talked to we had a not exactly, but we had a 1031 attorney on a webinar last week,
Mm.
and
Right.
then I've spoken to a few people that raise money for DSTs. I don't know. I know
Yeah.
typically it's very large institutions that kind of put all that together. So I'm assuming the legal costs are high.
Yeah.
Because you need to be able to justify that cost, and so you need to be able to raise a lot. But yeah, I'd love to learn
Yeah.
more. I don't know how that would work. So if you're familiar
So
with that, I'd love to chat.
I'm
if
not. I'm just trying to gauge how much DST money is floating around in the marketplace versus just doing 1031 exchanges into ticks for certain assets.
yeah, for context, for folks who are listening, DST, that's a Delaware statutory trust. And the way it works is like 1031s don't always deploy all the capital into a deal. So they've got a little, maybe like a million, or they may have deployed 10, but they've got another million that they need to deploy somewhere. So they can put it into a DST. That DST can direct that capital into a deal. So it's almost like a fractional 1031. Like instead of paying tax on that boot, they put it into the DST. And then, so there's actually a dude, I actually brought him in to talk. I can't remember his name off the top of my head, but he deals solely in DSTs. Like that's what he teaches. That's what he raises capital in. So that I just wanted to share that context with people because we're throwing around acronyms, and I'm sure some people are scratching their heads.
If you
Go
remember who that guy
ahead.
is, send him over to me.
I will. Yeah. Just
Here,
shoot me.
Conversation.
Dennis, if you go look on LinkedIn too, if you just type in DST, I mean, there's quite a few guys that pop up. I talked to a guy last week. He said they raise, I think, a few hundred million per year for that. So I don't know I'm sure it's,
Yeah.
at least a few
Every
billion out there. But
Yeah, the only problem with LinkedIn or any of these social media sites is that anyone can say that they've done something, whether or not they
sure.
have is.
I got a dude who's done it. He's a public speaker and all that. I'll
Yeah,
I'll get you his
yeah.
info.
Yeah.
I mean,
Now,
we're all
taking
knuckleheads.
1031 money or DST money into a deal does add a touch of complexity to it because Dennis had talked briefly about it. It's a tick, tenants in common. You do have to title the property differently. And you do have your SEC attorney needs to be in the loop and like structuring things appropriately because these 1031 investors are not technically investing in your syndication because they can only invest in real property, not interest in real property. So you're almost like partnering with a 1031 to buy the property. And that 1031 trustee or whoever is managing that is actually technically they're more than an LP. They have more say. They can influence whether your refinance or your sale of the property happens because they need to sign off on it. So that's just something to be aware of. But it can be a great topic, a great thing to explore when you're raising capital is getting 1031 money in. Go ahead.
Another way to think about tenants in common is think of them as you're taking on another partner,
Exactly.
except it's a
Yeah.
partner to the entire ownership entity.
Yep.
Yeah.
That's the best way to think of it.
It's kind of sort of a GP, but not really, because they're not
No,
really
it's
going to
not
tell you
even
how
a
to operate.
GP.
They're
They
trying
are
to,
they're a
yeah,
partner because a
they
tenant in
can't tell
common
you.
has
Yeah.
voting rights based on the amount of ownership that
Right.
they have in the actual property.
Yeah.
So if your entity is a owner in the property as well, the amount of your voting rights for the entire entity, the GP, the
Mhm.
LP, the entire entity, is structured around how much remaining equity is left. It's a little
Yeah.
bit.
And they can influence capital events, right? Like they have
Yes.
control over that.
Yeah,
Yeah.
because they're a partner.
Yeah.
They're a partner.
Even though they're not managing the property, you
Right.
are, the GPs are. But yeah, they're sort of like a silent but deadly
Yeah.
partner.
I've never done one. I've never done it that way, but I just know that
Yeah.
they can be pretty sloppy and messy. That's all. So
And you just need a competent SEC attorney to make sure everything's
yeah,
up above board because it is a substantial change if you try to incorporate 1031 money later in the deal, and your other investors probably need to be okay with it, the ones that have already committed, because it is a substantial event. But worth exploring. And yeah, sorry, we are actually past the hour. I want to respect and honor everyone's time here. Dustin, I do appreciate you taking the time and sharing your valuable knowledge with us today.
Yeah, absolutely. Yeah. If it's okay, it doesn't show the um uh people or numbers or whatever, but yeah, I'd love to take a little screenshot of you and I and can post it
Sure.
on LinkedIn and stuff. So
Yeah.
cool. 1, 2, 3. Cheese. And tell we have kids. So
All right, guys. Appreciate it, and I hope everyone has a great day. We'll see you around.
all right. See you, Brandon. Thank
All
you.
right.
thank
See you
you.
guys. Take care.
Bye bye now.
Bye.